When a corporation develops a piece of commercial real estate, they create a substantial capital investment. The resulting structure is tangible, fixed in location, and holds measurable market value. Under MFRS 140, management's financial intent for the property determines its accounting treatment. While the physical structure is a fixed variable, the classification depends on whether the entity plans to occupy the space or lease it to others. To qualify as an investment property, land or buildings must be held for the specific purpose of earning rentals, achieving capital appreciation, or both. Properties used for an entity's own production, administration, or service delivery fall under MFRS 116 for property, plant, and equipment. Similarly, real estate held for sale as part of ordinary business operations is classified as inventory. This creates an accounting boundary defined not by construction materials, but by the specific way the asset generates its cash flows. In practice, corporate intent can be multifaceted. Buildings are often mixed use, and service agreements can complicate leases. These scenarios require a systematic framework to ensure consistent classification. The MFRS 14 standard provides baseline definitions to distinguish between different asset types. Sections 2 and 3 of this summary clarify that land held for long-term appreciation is an investment property, while owner-occupied property is not. By constructing a logical decision tree, we can move through these definitions to address complex boundary cases, select the correct measurement rules, and record the resulting accounting impacts. This logic tree provides the structure needed to navigate these classifications, offering a consistent approach to the asset scenarios found in professional exams and corporate balance sheets. A common complication arises with dual-purpose buildings, properties where one portion is rented to tenants while the owner retains another portion for their own administrative staff. The first test is physical and legal separability. If these portions can be sold separately, the accounting follows the split. The rented portion is governed by MFRS 140, while the owner-occupied portion is treated as property, plant, and equipment. However, if the structural or legal arrangement prevents the portions from being sold individually, the standard requires a different approach. Consider a 20-story building where 19 floors are rented out and one is used by the owner. The owner-occupied space is exactly 5%. MFRS 140 specifies if this portion is quantitatively insignificant, 10% or less, the entire property is classified as an investment property. These quantitative thresholds prevent the administrative burden of splitting an asset's bookkeeping when the owner-occupied component is a minor part of the overall operation. Another gray area involves properties that generate rental income while also providing ancillary services to the occupants. The determining factor here is the significance of those services in the context of the overall arrangement. We can contrast an owner-managed hotel that provides daily cleaning and meals against an apartment block where the owner provides only a basic security guard at the front desk. Section 5 of the summary differentiates between these levels of involvement. It separates properties with insignificant supplementary services from those that function as an active, owner-managed business. The hotel's extensive service model makes it an operating business, classified as property, plant, and equipment. Conversely, the apartment block security service is considered an insignificant addition to the lease, allowing the property to remain an investment property. When an owner provides significant operational services, the asset is no longer viewed as a present investment, but as an active business operation. After classification, the property is initially measured at cost. This includes the purchase price and any directly attributable transaction fees, such as legal costs and property taxes. Specific expenditures are excluded at this stage. General startup costs and abnormal waste during construction are not capitalized into the asset's initial carrying amount. Following initial recognition, an entity must choose a model for subsequent measurement, either the fair value model or the cost model. This choice must be applied consistently to all investment properties. Under the cost model, the asset is recorded at historical cost, reduced over time by accumulated depreciation and impairment losses. The fair value model follows MFRS 13, where the asset is adjusted to current market value at each reporting date. Here, no depreciation is recorded. Because depreciation is not used, any changes in market valuation are recognized immediately in the profit or loss statement. The choice of subsequent measurement model determines whether market volatility and physical degradation are reflected immediately in a company's reported earnings. Over time, an entity might change how a property is used, requiring a transfer between investment property, property, plant and equipment, or inventory. Section 8 outlines strict requirements for these movements. Transfers are only permitted when there is clear evidence of an actual change in use. A change in management's internal intent is not enough to trigger a transfer. The shift must be observable. For example, the start of owner occupation or the beginning of a development phase with a view to sale. If a transfer occurs under the fair value model, the property's fair value on the date of the change becomes its deemed cost for its new accounting classification. These restricted transfer gates ensure that assets are not moved between categories to manage the appearance of the balance sheet. The final stage of the asset lifecycle is derecognition, where the property is removed from the financial statements. This occurs when the asset is sold or when it is permanently withdrawn from use and no future economic benefits are expected from its disposal. The financial impact of derecognition is calculated by subtracting the asset's carrying amount from the net disposal proceeds. The difference is recognized as a gain or loss in the profit or loss statement. By tracking the asset from classification through measurement and disposal, we see how the standard structures the accounting for real estate investments. This process is built on 3 pillars: purpose-based classification, consistent subsequent measurement, and evidence-based transfers. Accounting standards act as rigorous parameters, designed to ensure an asset's financial reporting reflects its specific function within an entity's operations.